I'm Greg Hunter. Welcome to USAWatchdog.com. With us, one of my favorite guests for real information. He takes data and instead of doing all the gimmicks and all the other things to it, he puts it in a form which takes it back to where there's no gimmicking and you get real numbers, what I call real numbers and accurate numbers. I'm talking about John Williams, Economist John Williams at shadowstats.com. John Williams, thanks for joining us today on USAWatchdog.com, and thanks for coming on for this quick update.
Thank you for having me, Greg.
I just want to read some numbers out, stuff from you and other stuff. Intensifying economic risk. This is from you. A renewed downturn. You're predicting production activities down. Housing is not recovered to where it was in 2007. I mean, even though housing starts are up lately, your GDP just came in at 0.9%, was revised downward, and yet we're at all-time highs in the stock market. What's going on with that?
Well, we have a very bad situation still with the economy. Stock market, there's a lot of hope there, and there's some reason for hope. But let me just take a minute to define a couple of things in terms of the definitions I use, which are the old standard definitions of the economy. But you'll hear me emphasize, for example, that housing starts have yet to recover their pre-recession high. Just let me take a minute and explain.
Okay, go ahead.
What's involved in the business cycle. What you have to keep in mind is that before World War II and the Great Depression was the period leading into World War II, all economic downturns were called depressions. And a depression, very simply, was a dip in the economy, and then it would come back up again. Well, there were various parts to the depression. As the economy turned down, that was the recession. Then as it hit the bottom, that was a trough. Then there was recovery as it headed back up until it hit the pre-recession high. And then beyond that, the economy was in expansion. So when people talk of recovery, what they're talking about is recovery from the trough. You haven't entered a period of economic expansion that normally would follow. And what we're seeing here right now is in many ways parallel to the Great Depression in terms of duration. It's not as bad in depth, but it's been miserable. And it's a reason that, again, you had a shift in administration. I mean, Mr. Trump got elected not because the Russians were playing games, purportedly, but because the average guy wasn't making it and people wanted to see a change in the economy. Let me just put things in perspective right now. Those who follow me know that I have my own alternative measures of a number of factors where I adjust for inflation where I think it should be. And because if you understate inflation, as the government does, when you use that to deflate the economic statistics, let's say you deflate retail sales. Retail sales is reported. That's as everything is sold in current dollars. But if you have high inflation, what you want to know if you're a retailer, gee, my sales are up from last year, but is that because I've raised prices or is that because I'm actually selling greater physical volume? And when the government measures economic activity, it backs out inflation so that what you're seeing is physical volume, not changes in inflation, at least in theory. Now, if they use too low a rate of inflation when they adjust their economic numbers, that tends to overstate the what they call the real numbers, the inflation-adjusted numbers, the numbers that are supposed to reflect volume. And that's been a common problem. But putting all that aside, one of the best series you'll find over time, and it still has some issues, is the Federal Reserve's industrial production. It goes back to virtually a century now, 1918. And it was used basically to track some of the key turning points in the Great Depression. Great Depression turned down a month or two, we entered it officially a month or two before the stock crash in 29. Then it troughed into the early 30s. It actually rebounded, came out of depression very briefly for a couple of months, and then it went back down again. and bottomed out and came up and did not fully recover. We did not enter a period of full expansion until 1939, a decade later, based on orders being fueled by the developing war in Europe. Now we have today a circumstance, and this is based on the Federal Reserve's own numbers, where the industrial production turned down. It crashed at the end of 2007. It hit bottom in 2009. There was some recovery, and in fact, with industrial production, it went into 1 month of actual expansion. That was in November of 2014, and then it fell down again. Right now, it's below where it was in 2007 by 1%. If you look at the manufacturing component of that, which is the dominant component of industrial production, and industrial production itself is something like 61% of the GDP, the manufacturing never recovered, never got to its pre-recession high, and it's still down 5% from where it was in 2007. So what we've seen, if you go back to the Great Depression, industrial production basically moved with the headline GDP. And you had, in the Great Depression era, a period of time there with the, I believe it was 37 quarters of non-expansion in industrial production. You did have that blip up before we went down again. Basically the same thing with the GDP. Right now, we've seen 22 quarters of GDP expansion above its pre-recession high, yet we've seen 36 quarters of non-expansion in industrial production. We're a quarter from rivaling what was seen in the Great Depression, and I think we're going to exceed that. That's in terms of non-recovery. So this is not a normal economic cycle by any means. We're not seeing a recovered economy. You look at the housing sector, housing starts, even or you have real crazy gyrations in numbers like the new home sales, up and down, not very stable, but none of those housing numbers have recovered their pre-recession highs. Yes, you're off bottom, but you haven't recovered, and you're still well shy. I mean, you're down on average 40 to 50% in most of the real estate measures from where you were before this, before the economy began to collapse.
And you're saying, I mean, this is stunning to me that we're looking at a real comparison in terms of industrial production. 1 quarter, 37 quarters, not 37 months, 37 quarters. And we're looking at with all the money printing, the QE1, QE2, Operation Twist, QE3, all the stuff they did, all the money printing, all the bond buying. You're telling me that we still have something resembling the Great Depression in terms of industrial production? That's got to be terrifying.
It's not as deep as the Great Depression. In the Great Depression, you had much sharper decline in activity.
But the economy should have taken off like a rocket, and it didn't.
And teams, in terms of duration, and in terms of non-recovery, we're seeing a direct parallel to the Great Depression. And the quantitative easing was never designed to stimulate the economy. The Fed here's been playing games. Federal Reserve's primary function in life, despite all the hype that they'll put out, we've got a congressional mandate to keep the economy growing and to contain inflation. Well, indeed they do. But their primary function is to keep the banking system afloat. And what happened was the banking system effectively collapsed back in 2008. They did everything they could to prevent it from collapsing. We were within a day or two of the system failing.
Are we closing in on that again?
I'm sorry?
Are we closing in on that again?
I think we are, because what happened was they put in a lot of stopgap measures to buy little time. They provided whatever liquidity, what cash, lending, guarantees, whatever they had to do, they did except they didn't do anything to fundamentally address the underlying problems, such as economy, such as the long-term credit worthiness of the United States. And they've done their best to bring the banking system back to normal, but the banking system is not back to normal. It's not lending normally. And unless it starts lending normally, it's very difficult to, this is where they would normally stimulate the economy. They would encourage lending. And the lending would help stimulate spending and expansion. None of that's happened. And the reason it hasn't is that the banks are still not healthy. If you look at we just recently had existing home sales published for the month of February, and that was it was down a little bit for the month, up year to year, and they say, "Oh, this is the highest level since." Well, we're seeing the highest level since 2006. That may be, but it's still down 20% from the pre-recession peak. And what you've seen there is that in the last month, 27% of home sales were all cash. Now, normally you wouldn't have that, and that was the highest level in 2 years or so. The banks are not. If the banks were lending money normally, that would be a much lower number. People are having to go to all cash because they're having credit problems. Only people who can, a lot of the people who can buy are those who have the cash. The number of the percent of foreclosures in the sales is higher than it was 6 months ago. So that's not. We're not seeing positive signs there now. In terms of some signals that are indicating that things are getting worse. This is headline numbers out of the Bureau of Labor Statistics. If you look at the real average weekly earnings for production and supervisory people, and that's that's your core working group, and it's the only series for which they have a long-term historical base. You just saw we've had reporting through February. Virtual certainty that you're going to have a year-to-year contraction. That's already in play, and it looks like you're going to have a quarter-to-quarter contraction. That has not happened outside of recession. We're still in recession. We've never recovered. I mean, we're not in the correct. Just having made all the points, we're not in the. Actually, I think we are in a new downturn. And have been since 2014, but no, that's not formally recognized. But we haven't recovered. At best, you're stagnant, and at worst, you're turning down again.
And you think we're going to? I mean, what happens if all the stuff we did just staved off a huge, deep crash? If all the stuff they did, and then what are they going to do if we have a huge, steep, renewed crash like you're forecasting? What are they going to do? They've already used all the bullets and the grenade launchers and the tanks and the nukes, haven't they?
No, no, they haven't. The Fed has. The Fed again has not been trying to stimulate the economy so much as it has been trying to provide liquidity to the banking system. And when they put forth quantitative easing, they say, "Oh, we're doing this to stimulate the economy." Nonsense. They're doing that to provide liquidity to the banks. If they're doing it to stimulate the economy, they would have let the banks who were getting this extra cash lend it into the system, as opposed to putting it back with the Federal Reserve and on deposit as excess reserves. Then the Fed paid interest to the banks.
So what are they going to do in this next downturn that you see is clearly coming?
Bear with me. I'm contending the downturn is there. You're going to see it increasingly, and as a result, from the Fed standpoint, that stresses the banks. Downturns put financial stress, solvency stress on the banking system. Banking system still isn't healthy as it should be. So what I think is going to happen here as the economy deteriorates, the Fed, despite all its hype and recent interest rate hike, despite all the hype that it's going to raise rates further, is going to move back towards quantitative easing, and at least the markets are going to expect that. And as they do, you're going to see heavy selling against the dollar. It's going to spike oil prices, going to spike inflation. We've been through that before. Now, in terms of
and you think we're, and I don't mean to interrupt you, but you think we're close to that, even though the Fed is saying, "Oh, the economy's just fine," and we just had the Atlanta Fed revise GDP to 0.9%, and Janet Yellen says the economy's just fine. You think we're close to reverse in QE?
Your forecasts are dropping for the first quarter GDP. What's ahead of us the next quarter or two is not good news. Now, what you have to keep in mind here,
but you think that we're on a turning point where the Fed is going to take the car out of first gear and they're going to cram it into reverse. Is that what you're telling me?
They're going to go back towards trying to prop up the banking system under the guise of stimulating the economy. But here's the issue. The Fed is not stimulating the economy. They're trying to preserve the banking system, which is an honorable goal, particularly if you're the central bank. Now, from the standpoint of the economy, we have a new administration. We have a new administration in place because the average guy recognized the economy was not doing well. Was hoping there'd be a change, and the Trump administration's been talking about a stimulus. The new president I think, understands the problem. He doesn't have the political cooperation yet that he needs, but I'm reasonably comfortable that there's going to be some stimulus package coming out of the new administration, and if the politicians in Washington started to think a little bit along the lines of why there's been a change here and what they're going to be facing in a couple of years or a year and a half or whatever with the congressional election midterm, you might get a little more cooperation. If the administration now moves to stimulate the economy, they can do so. It will help the economy, but there's a lead time. The economy just doesn't turn overnight. Generally, it takes 9 months to a year. So anything that happens now, you're going to be seeing in 2018.
And is this why Trump came in and said things are a mess, and that's why he wants to cram this health bill through so we can get tax cuts and stimulus done? Is that why?
Because didn't quite hear you on that, Greg. Could you?
Is this why Donald Trump came in and said, I inherited a mess because of the budget. We just hit the debt ceiling at $20 trillion, and he wants to get tax cuts in and stimulus done, and he wants to, cram this health care bill through, and he knows that he's got to do something right now just to have something go off in 2018. Is that right?
He sure does. At least, if he's stymied in it, those voters that voted for him will have a sense as what they have to do if they want to still have the changes made. I don't think you've got 2 years to get the system in order. What the other part of this, and you're not hearing too much. So
he's got to do something right now. He's got to
do something right now in terms of the economy. But when he does this with the economy, there are also the questions with the budget deficit. They're going to spend money to cut taxes, irrespective of how you balance it out. Good shots are going to widen the deficit here. Long term, and what can kill the dollar and will still kill the dollar going forward is a global perception that the long-term solvency prospects of the United States are nil. There's no way the U.S. can pay off the obligations that it currently has in hand. Net present value is what you need in hand to cover them today, and this includes everything from the existing federal debt to unfunded liabilities and Social Security and Medicare. It's over $100 trillion. There's no way that can possibly be paid off. That has to be brought under control. And my contention is that if this is presented along with a package as to how you bring the long-term deficit problem under control and reestablish the long-term solvency of the United States, it's not easy. But if that can be done at the same time, that'll keep the dollar strong. It'll keep people investing money in treasuries, and it will enable them to temporarily boost the deficit some to get the economy off the ground. It's a very difficult circumstance, but you do have some creative people there, and I think there's a chance it'll work out well, but it needs the cooperation of Congress.
Is this reason why gold has caught a bid in the last few weeks, that they smell this coming? They smell a bigger deficit. They smell a lower dollar. They smell some money printing, QE, whatever you want to call it, propping up the banks, whatever you want to call it. Is this why gold is catching a bid and silver too?
It may well be. The
I mean, there's people are smelling the fact that big money is smelling the fact that they're going to have to do something big and soon. Am I right?
Yes, you're seeing the. Let me put it this way: you're seeing the economy slow down. Some people are recognizing that. The Fed's FOMC statement after they raised hikes in a week or two ago. That was it was what they analysts considered more dovish than had been expected. The Fed knows what's going on here. They're trying to get maybe a little bit higher in rates, but they have a circumstance where they're not out of the woods with the banks. And what they're hoping for, and in fact, you've heard some comments. Gee, maybe the Trump administration is going to bail us out here and stimulate the economy. Well, I hope they do, and then the Fed can just concentrate on the banks. But the Fed is still fighting the battle that it effectively lost back in 2008. The banking system isn't right, and if they can't, Mr. Trump has several problems. One is the economy. One is the long-term budget deficit and getting all those things in line. And the third is the Federal Reserve that lost control of the system. The system effectively collapsed. They haven't been able to bring it back to normal. He may have other options with the banking system. I haven't heard too much talk about it, but if I were in his circumstance, I'd certainly look at it.
Do you think that Donald Trump, and I've been asking this question for people, just asked it of Doug Casey, and I said, do you think Donald Trump will, if they start selling treasuries in mass, and I think a lot of people have been selling treasuries, you talk about that 16, 18, whatever it is now, trillion held outside the country. I mean, who the heck would hold a 10-year treasury at 2% or 1.8 or whatever they bought it at? Who would hold that? And are you thinking that at some point, if their selling intensifies enough, Trump will just call over to Steve Mnuchin, the Treasury Secretary, and said, stop redeeming the bonds, make them hold it to maturity? Do you think he may do that?
I don't think so. That would be an act of default. You don't want to do that. That'd
then he would just print money to liquidate the.
What he needs to do is address the long-term solvency issues of the United States, and if he can convince people, yes, we're going to be able to handle this, and at the same time take action to stimulate the economy, that could be very bullish for the dollar. Fundamentally, I mean, what we've seen, the Fed's been playing games here. Oh, we're going to hike rates, and that's helped to boost the dollar.
Is this why Donald Trump is saying things like we're going to cut 30-40% out of EPA, and we're going to cut 28% out of the State Department, and no foreign aid, and we're going to make massive cuts, and people in Washington are freaking out? Is that what he's trying to do, to redirect the money into the economy and out of the government?
That seems to be what he's looking to do. I'm not privy to all the to what they're doing.
But based on your observation, do you think that's what his goal is? He wants to fire federal workers.
That certainly is part of it. What I'm saying is they have to go beyond that. They have to have a comprehensive. If they want this to work and to save the system, and Mr. Trump will come out here with his face on Mount Rushmore if he does. He's got to turn the economy. To do that, he needs to increase government spending in areas that would help stimulate the economy. He's got to cut taxes, all that is in the works in some form. He also has to, as part of the process here, very likely will be a widening of the budget deficit, which could kill the dollar and kill the people holding treasuries. So at the same time, he has to come up with a package as to, okay, let's say something along the lines, yes, we may see a little widening of the deficit here as part of our getting our feet back on the ground, but we're bringing the U.S. economy back. We're taking actions, and here's how we're going to do it to bring the long-term budget circumstance, the long-term obligations, the long-term deficit of the United States under control.
And there's no way Trump's not thinking like you are right now. He has to be.
I can only speculate.
But in your mind, speculation, he's got to be thinking this way. He's not a dumb guy. He went to Wharton Business School.
I can tell you what I'd be looking at. I would assume he has people there who are. And if they do that, then you've got the rest of the world saying, yes, boy, they've brought things under control, and they'd be happy to own the treasuries. But
And if they don't do
I
that,
don't know this can be done, but that's what you got to do.
but if
He
they and if
was
they don't, if he's not successful, hold on, I'm going to interrupt you here. If he's not successful, if he doesn't bring the long-term deficit under control and he can't truly stimulate the economy, what do you think will happen?
the same thing that would have happened otherwise, and that is that you're going to see the banking system go again to the, and this may still happen. That's why he also has to look at bringing the banking system and the Fed under containment, and maybe some reorganization there. But the problem will be with the dollar. If the system's not brought under control, the rest of the world's going to dump the dollar. They see the long-term situation for the United States as one of no credit worthiness. Again, you go back to 2011. You had a debt ceiling there, and there were some people in Congress threatening that well, maybe it'd be nice to default. That would, it might be a way to. It's a threat here we can use to bring things under control. That actual threat of default is what caused the downgrade in the. You don't want to play around with anything that would suggest default. Now, Alan Greenspan at the time, God bless the man, he always speaks what's on his mind, at least a fair amount of the time he does.
Well, he's telling people to buy gold now, Alan Greenspan.
Oh yeah, he's been, I think buying gold's a good idea. But what he said at the time was, look, there's no risk of the U.S. defaulting on its debt. Its debt is denominated in dollars. The U.S. prints dollars. The U.S. can print the dollars it needs to pay its debt. So it's not going to default on its debt. Now, technically, there he's correct. But that's where you get into the long-term hyperinflation, because if you don't have the basis for the cash, yes, you can print the money. But if you print the money, too much money, you get the hyperinflation. And what happened with the quantitative easing, you actually saw some of that. The Federal Reserve today is holding $2.5 trillion worth of treasuries that it bought in the quantitative easing. It hasn't sold off a penny, keeps rolling them over. The Treasury pays them interest on that. The Fed pays the interest back to the Treasury. The Fed effectively has monetized $2.5 trillion of the debt. And if there's increasing monetization, which is, I think, what's going to happen here. Again, if you have dumping of the dollars, aside from the Fed's quantitative easing providing liquidity to the banks, guess what? They're buying treasuries. They buy the treasuries. They're the people buying the treasuries from the Fed. It may be through the banking system. The banking system buys it, and the Fed buys the treasuries from the banking system, but it effectively provides the needed funding to the Treasury. So there are a couple of advantages for them there, and actually going back to the quantitative easing, but it's long-term destabilizing. In fact, I think very short-term would be very destabilizing. Give you a run on the dollar and big spike in inflation, and you're off to the races with hyperinflation.
And you're thinking that Trump is probably going to pull the inflation trigger. He's not going to default, so he's going to tell people to print the money. They'll buy the bonds. They'll buy the debt. They'll monetize it. They'll buy the debt for printed money.
I think what he's going to do is try to bring the system into balance. I mean, if he saw the problem, he's in there. We'll see what happens. Again, I'm not privy to all that's anything that's discussed other than what you see in the press. But it is. I know they've got creative people. I know they know the problem. So one can hope that there will be some changes here that will stabilize the economy, get the economy growing. If we get the economy growing, that solves a lot of problems. And as he has noted, you get the economy growing, you get that helps with the budget deficit, because people will be paying higher taxes off their earnings. So will corporations. I mean, you can cut the tax rate, but if people are making more money, you're still going to get a greater flow, but it's a happier flow into the Treasury's coffers. That'll help That'll help with the budget deficit. But there's going to be an interim period there where it's dicey. They probably have some widening of the deficit, and to make things work out, now that you've got the effectively the mandate to do what's necessary to bring the system back under control, now is the time to bring the long-term budget deficit under control. If he can do that, and I think he's got a chance of pulling the whole thing off. If he can't bring that off, pull that off, and he's got, again, current issues with the Congress. I don't think he's got 2 years to maybe work this out in 2019. This is something that's got to be worked out now. If it doesn't get worked out soon, the markets are going to lose patience. You're going to have heavy dollar selling, and a lot of trouble. So it's.
And how many U.S. liquid dollar assets are held outside the country? You had said in the past 16 trillion. Has that increased?
It's still that order of magnitude. I mean, you're seeing some
about 16 trillion held outside the country, liquid U.S. dollar bonds, Treasury, stuff like that.
Then of assets that can be liquidated and
about that much, 16 trillion.
It's order of that magnitude, yes.
Is that the reason why the gold market is taking off? They even if he's successful, he'll expand the deficit. He'll print money. We'll have some inflation. He said the dollar's too high. Donald Trump and his administration. They want a lower dollar. So is that what the gold market is saying, that we're going to have? If he's successful, we'll have inflation. If he's not successful, we'll still have inflation. I mean, is that what the gold market is saying? Inflation.
Well, no. Well, let me put it this way: inflation, as things stand now, is it's really a debased dollar, and the debased dollar will lead to the inflation. As things stand, you have a debased dollar ahead of you, and that's a good reason to be in gold. The gold market gets knocked all around by special interests such as the central banks. And if it gets a little too strong, they may knock it down again. I don't know, but the fundamental pressures there are still right. If you'd bought gold back in 2000 along with the stock market, and you had the stock market with your reinvested dividends and gold today with the selling we've seen, a lot of it orchestrated by central banks to try and discourage the ownership of gold, you're still ahead of holding the gold. The reason for holding the gold is not the near-term volatility. I mean, the people who trade the near-term volatility. What I'm looking at is that the system here is faced with a devaluation, a full-term devaluation of the dollar. Dollar becomes worthless. In that circumstance, if your assets are denominated in dollars, you want to get your assets in something that will be preserved in the event, where the value will be preserved in the event of that dollar debasement. And physical gold and silver are really the primary assets, particularly gold, for that. Millennia of tradition and precedent behind that. A lot of near-term volatility. I didn't think we'd see the volatility that we've had in the last couple of years, but you've had a wide variety of things, but the underlying fundamentals have not changed. The U.S. dollar still is long-term insolvent. What has changed here is that there's a chance that the Trump administration can correct it. As far as I can see, it's the last chance to correct it. If it doesn't happen here, if the Congress forestalls it, I don't think they've got until this next election. So that I think gold's still a good hedge. I sure hope the administration can do it, and it'll be a very happy circumstance if they can.
John Williams, Economist John Williams, shadowstats.com. There's some free information on the homepage of shadowstats.com. John Williams, thanks for getting into it and this back and forth, talk about the monumental task financially economically that the Trump administration has to do, and they have to do it while they're being surveilled and wiretapped and undermined, and and then there's a counter coup going on and a shadow government trying to destroy him at every turn. I mean, it's a Herculean task. What you're saying, just if he had everybody in the polling for him in a normal transition, but the transition is awful. So thank you for coming on and talking, about the economy and the long-term solvency of the U.S. and the U.S. dollar. John Williams, shadowstats.com. Thanks for joining us today.
Thank you for having me.